G'day everybody, welcome to another weekly general update for the 24th and 25th of March. Now last week we weren't expecting a lot of key data, and so it kind of turned out that way that markets didn't really do a great deal. There was a bit of ups and downs in pricing, but stock markets, commodity markets pretty much finished the week where they started. So let's have a look at the action. First of all, just a reminder that this is general advice only, and that we operate under the licence of Australian Financial Services. Now the action for the week, the S&P ended up declining about 7 points, but it had a pretty good couple of weeks prior to that. To me, it just looked like a little bit of profit taking. The market had got overextended and it pulled back to the moving averages, so that was all perfectly normal action to my mind. And it really clears the way for a run towards the 1440 level that I've been talking about. And in terms of timing and seasonality, if that were to occur sometime during May, then that would pretty much fit with the normal seasonal patterns as well. I then expect from there, May, June, July, August tend to be slower, either sideways or quite often we get some corrections down. It's a period when there's summer holidays in the States, trading volumes are much lower, and generally markets can bounce around on much lower volumes. But I'm really expecting that after that period, perhaps from May through to August, that we're going to see then another leg higher into the year end, and that possibly could extend up to 1550, particularly if corporate America continues to do as well as it has been for the last year or two, and we're now seeing a comeback in the manufacturing sector as well. Now money flows are coming back into the market, but there certainly has been some smart money hedging in the NASDAQ of late, and American indices are much more heavily weighted towards technology stocks than are the Australian ones. And so the fact that the technology stocks, particularly stocks like Apple, have done so incredibly well, I think some smart money is just hedging their bets there. They're not necessarily saying that prices are going to fall over, but they're recognising that prices are quite extended and they're just putting in place some hedging. The worst case scenario for me, if we don't advance from here up to 1440, would probably be a bit of mild choppy downside. I really think that's the worst case scenario. So that's a pretty good environment for us to be trading in. Now the ASX declined 6 points on the week, pretty mild downward move. Banks were the best sector. They offset the downside that we saw in resources, and even to a degree we saw a little bit of weakness in energy last week at the major stock level. But our market still really needs to break the 4350 level before we could look towards a more meaningful advance towards perhaps 4500 or 4600. Now bond yields still easing back. There was a spike a short while ago and we're just easing back. So for me, I need more data to know whether this is the start of something that's going to go into a trend or whether it's a spike in bond yields like we saw back in October and they're going to just settle back down again. Bond yields are important because if there are a sustained move in bond prices down and bond yields up, then that's indicating expectations for inflation, which will tend to be positive for stocks and will certainly be positive for gold. The US dollar was down slightly on the week. It was a bit all over the place but ended up down a little bit on the week. Gold rose $2 but did have some considerable volatility. I believe we're still in a wave 2 correction, but we may have seen the lows. That's entirely possible. We really need to see a close above 1700 to be sure about that, and we'll have a look at the chart in that in a minute. Silver was down by 30 cents, not much movement there, same comments as for gold. Oil rose on the US indices, so the West Texas Intermediate crude rose, the NYMEX sweet light crude rose. Brent crude did fall a little bit, so it was a little bit mixed, but oil futures are still at elevated levels. And interest in energy stocks is extremely high, and when you look at some of the exploration stocks, the gas stocks in particularly in America, the Australian stocks in America, it's really kind of looking a bit bubble-ish to me, because we're getting all sorts of stocks that don't have anything more than some exploration acreage are charging ahead. So yeah, just be a little bit careful in that area. Copper's still holding a range just under $4, and that's an area that's highly profitable for many copper producers around the world. We'll just have a quick look at the spot price on copper. This is over the last year, and you can see we got down to $3 in September, October, when there was some real fears about commodity prices, but we've bounced back, and now really all this year it's been tracking between around $3.75 and $4. So copper holding very well at this point in time. Now the overall strategy, before we get to the charts, on the S&P, I think we're now probably heading higher for another 6 to 8 weeks. That's not a guarantee, but I think that's where the odds certainly are. In terms of overall exposure, the level that you choose is highly dependent on your particular risk tolerance and trading style, so you need to make your own decisions there. But I would recommend that you maintain some cash up the sleeve, because volatility in the market can create opportunities, and you want to certainly have a little bit of cash to take advantage of those opportunities. And again, as per last week, the entry technique, I believe the safest way to be entering is using principles of reversion to the mean, and that should limit your downside risk. Certainly chasing prices that are rocketing away is absolutely not recommended at the moment. An exit technique is just to continually take some partial profits, keep turning your money over, and just always evaluating the risk of open positions against the reward that they may deliver to you in coming weeks or months. And if there are any confirmed reversals, then don't waste time. Get out of them fairly quickly. So let's have a look at some charts. First of all, this is the S&P, and this is just a very broad Elliott wave structure. I'm not an Elliott wave fan by any stretch of the imagination, but I do find the basic structure does reflect crowd behaviour quite well. So my reading of the situation is that we're coming off the November lows at 11.58. We had a wave 1 up. We got a wave 2 correction of that, which is perfectly normal crowd behaviour. We then got a large wave 3, which is again perfectly normal. Wave 3 is often the longest and strongest of the 5-wave pattern to the upside, which really reflects how human psychology thinks and reacts to the market. We've then had a brief wave 4 down, which culminated in a fairly abrupt fall on the 6th of March, where the market dropped nearly 20 points. But then we're now in wave 5, and wave 5 will go to wherever it will go to. My view is that 1440 is not a bad target area, and it will go there within a series of sub-waves, if you like. So I think that's where we are at the moment. Last week we pulled back to the moving averages, which have provided support, and looking at a lot of individual stocks in the US, as well as looking at this overall index, I believe we probably saw a low on Friday night and a turn, because there's a lot of individual stocks that look to me, the patterns look like reversal patterns to me. So I think pretty reasonable chance we'll move higher. Let's just have a look at the bond market. So you can see here this is the 30-year Treasury bond. We had a spike back in October. It then went very quiet again as bond yields fell back down, and then we started to move higher about 2 weeks ago. Got to a similar kind of level. We've done a little pullback. That's quite normal. Now the question is, does it fall back into the range that it's been in now for quite some time, around about the 2.75 to 3% yield area, or does it start to head higher? And if it starts to head higher, if you see the 30-year Treasury bond in America up above 3.5%, then I think you'll see gold doing much better as well. So that's a key one to watch. The US dollar index really didn't do a great deal. It was down a little bit on the week, but you can see it's largely been just running up and down now since the end of January. Let's have a look at gold and silver. We'll look at gold on a weekly chart first. So we've had an ABC pattern to the downside, and I believe we're now in the next 5-wave move to the upside in gold. I believe that we bottomed in gold on the 30th of December at 15.20. We had a good run up. We've had a pullback, which is almost exactly to the dollar, a 61.8% retracement of this run from the end of December to the 24th of February. So I think now the odds favour that gold will move higher from here and perhaps back towards the 18 to 1900 area. That will certainly be assisted by what I talked about just previously in the bond market. So that's how I see gold. Silver will just tack along with it. And let's have a look at gold now. To me, it seems like it's based and ready to perhaps start heading up again. The MACD starting to turn. The RSI down at a fairly low level, at a point where a turn would make sense. So I think that's what we've seen. 1627 was the low on gold, and we got to 1628 on Thursday night. Let's have a look at our market, and you can see here that we are still basically stuck in this huge sideways pattern. Just extend this out a little. So we've still got this wedge pattern that's been in progress now for quite a few months. We did get a false break to the downside. It quickly came back into that, into the top of that wedge pattern, but you'd have to think that we're now some sort of chance of a breakout to the upside if the US market is going to head higher. Now, if we have a look at our individual indices, you can see on a daily chart that the materials index really has done very little now for some time and was a little bit weaker on last week. Banks certainly, much to my surprise, because I think banks have got so many headwinds, but the banking sector did move a little higher during last week, and energy, which had been doing reasonably well, pretty much marked time during the week. So that's really all that needs to be covered this week. I think we've really got some pretty good trading conditions ahead of us for, as I said, maybe the next 6 to 8 weeks. Care does need to be taken with the actual execution, but I think there's probably a very low chance of us getting a sudden correction to the downside, of course, unless something dramatic happens in Europe. But I think the fears there seem to be largely off the table for a little while. So that's it for this week. Cheers. If you want to trade and invest with us with a big edge on the market, go to our website, specialistshareeducation.com.au. You can access our free video series on creating trading cash flow and smart investing. Plus, you may also register for our weekly Ask the Expert webinar.